Good afternoon. I'd like to welcome all of you to our 2019 annual board meeting for Chester Incorporated. During this meeting, we're going to address areas of profitability and look at some of our performance throughout this last year compared to last year, as well as we'll look at functional areas of marketing, production and automation, research and development, human resources, and other key areas that have led to the profitability of our company this year. If you would look on top of your tables, you'll see some of the tables and charts that also spell out some of the information that we have available to you guys so you guys can follow along with this presentation. First, we want to again emphasize our mission statement. Chester Incorporated exists to be the primary company of choice for dependable, low-cost sensors. And so our generic strategy from the beginning of our company was to be a low-cost leader. And so everything that we've done has been in wanting to abide with that generic strategy. I'll provide a quick overview of things we're going to cover during this presentation and performance for this last year. We've actually had a sales of over $388 million. A ROE of 22.75%, a contribution margin of 47.2%, and we've actually had a cumulative profit of over $60 million, which is great compared to other industry rivals. First, we're going to address areas of research and development, and we're going to ask Louis Cologne to speak a little bit on behalf of this functional area. Our goal was to gain a 30% total market share by 2027 or simulation year 8. And what we found was that in round 7, we achieved a 26.4 total market share in units, while in round 8 or 2027 this year, we've actually achieved a 26.9 total market share in units, as seen here in our chart. As you can see, we've actually dominated the low market segment, 29.3 last year and 31.4, and we'll see a little bit in comparison to how we did with our rivals. In round 7 or last year, our company achieved a 28.3 market share in the traditional segment, leading our closest competitor Erie by 4.7 percentage points. We've also achieved a 29% market share in the performance segment, leader and closest competitor Erie by 4.1 percentage points. And then we achieved a 29.3 market share in the low-end segment and trailed only Erie Incorporated by 6.8 percentage points. Now this year, while our company decreased 0.3% percentage points in the traditional segment, we still outperformed our closest competitor, Erie, by 4.6 percentage points. So even though we decreased in our market share there, we still outperformed our closest competitor by 4.6. We've also decreased 0.6 percentage points in the market share of the performance segment, but we led our closest competitor again, Erie, by 3.3 percentage points. And on top of that, we achieved a 31.4 market share in the low-end segment. This is the only segment to reach our target goal. However, we were true to our strategy of becoming a low-cost leader. So as you can see, as I mentioned before, we led the traditional segment. Our performance segment led us to actually move and change our strategy a little bit. And we saw an opportunity there, and we'll talk a little bit about that later. But then in the low-end segment, we dominated the market, or we had a higher percentage rate at 31.4, which actually allowed us to still be the low-cost leader. Now, some of the pitfalls that we see moving forward. Last year, we needed to increase our sales in the high-end segment. We've only achieved a 14.4% market share in that segment. And that's the reason why we weren't able to accomplish our strategic goal that we started out with. We're the 4th team in this category because we're the only company, that has one product in this segment. Our desire is to add an additional product and gain a higher total market share as we see kind of an opportunity to grow in that area. This year, we created space to introduce a new product in round 9, or in this year. For the following year, we created space, and automation and plant capacity to be able to do that. introduced that new product. And then we decreased 0.3 percentage points in market share in the high-end segment. And that's what we experienced. But this should change again after the introduction of a new product that we launch this upcoming year in this segment. Now we're going to cover areas of marketing and what we did kind of in our strategy for that. We achieved a 29.3 total market share in the traditional segment in round 6, which was part of our goal was to reach 40% by this round, but we've only achieved a 29.3 total market share. The rationale behind that is we had too many products and competitors. So there were many other competitors that were vying for market share in the traditional segment, and so that caused the intensity of rivalry caused us to not reach our total market share, even though we were the highest in this segment. We achieved 100% customer accessibility, which is one of our goals, across every one of our products in all segments. So this year we were able to have customer accessibility in every single one of our products. And we did this for the last 2 years. So as you can see here, we maintained customer accessibility for the last 2 years of all of our products. And again, that's part of marketing. We did a very good job of utilizing our sales channels. We had 16 different sales channels, and we invested into our promotional budget as well as our sales budget to make sure that we were bringing awareness of our product and then matching up our automation to ensure that our product was marketable to our target. Next, we achieved in the traditional segment, we achieved a higher actual market share than was projected last year. We led the market share in the traditional segment last year, fulfilling again our long-term strategic goal of leading in this segment. So as you can see by this, and on your table, you'll see the graph as well. We've actually increased, and we were the highest in the market share in the traditional segment. And these are kind of our competitors where we ranked. We ranked higher. We performed better than our potential in this specific category. And again, that's due to positioning our product, selling our product at the right price, looking at our target audience and making sure that we line that up for sales. In the low end segment, we achieved a higher actual market share than was projected this last year in the low end segment. We led the market share in this segment, fulfilling a long-term strategic goal again of leading in this segment. And then we outperformed our closest competitor, Erie, by 0.3% as percentage points, as mentioned earlier, by increasing our sales budget to $231,000. So what we saw is Erie was leading last year with their leading product, Eat. And what we actually did this year is we invested $231,000 more into our sales budget so that we can again raise our customer accessibility and produce more sales for our product Sedano in this specific category. Now, as we enter into production and plant capacity, just to show you a quick synopsis of kind of where we are, we produce approximately 19,500 units, as you can see here, while having a capacity of approximately 11,500. And as you can see, our amount of units that we produce was a lot larger than some of our competitors, both Erie and Andrews as well. We sold 16,344 units across all our products this year. Our leading product was Cedar, as you can kind of see there, with 3,427 units sold. Our second leading product sold was Sedano in the low-end segment with 3,387 units sold. So those are our best products. Sedano and Cedar were priced at $16.50, the lowest price in the market, except for Erie's product Eat, which is priced at $16.40. And the reason why we didn't price it lower is because we wanted to ensure that we had a higher profit margin in regards to selling our product. So although the Erie's product Eat sold at a lower price for the low-end segment, we actually produced a higher profit margin because our material cost for that product was 50 cents lower. In their case, it was 50 cents higher than our product Sedano, while our labor cost to produce the product was 10 cents lower than the product Eat. And so we were definitely making a higher profit margin, and we chose to remain competitive at this price. Human resources, I'll pass this part over to Cassandra Dorsaint. The turnover rate stayed the same from last year as well as this year. And so a couple of the variables that contributed to this were the recruiting hours and the training hours stayed the same. We decided to not invest more than 80 hours and $5,000 into our HR, recruiting and our recruiting hours and our recruit spending, just because we realized that we were already at the top of our spending in comparison to benchmarking against our competitors, and we didn't want to see a diminishing return. Our productivity index decreased from 124.6 last year in round 7 to 122.9 in round 8. This is an aspect that we definitely want to improve on. Preferably, we want our productivity index to be high so we can see it continue to take down our turnover rate as well. So we want to continue to monitor our productivity index as we continue moving forward. So we might want to invest a little bit more on specific areas and watch that carefully. Now looking into our functional area of TQM. Last year, our company spent $1,000 across all TQM measures. That's in 2026 or in round 7. This helped reduce our material cost to 11.80 and our labor cost by 14.00. This investment also helped us reduce our R&D cycle time by 40.01% and our production cost by 60.02%. That's all because we invested $1,000 across all TQM measures last year. Now this year we did not invest into TQM measures as we realized that they would actually have a minimal return. The cost value was not worth the investment. As we benchmarked against our competitors, we realized that our rivals had the same material costs and labor costs as our products. So they had the same 11.80, 14, 40, 60.02. And so we found that this lack of investment this year actually saved us at a minimum to $10,000 while our cost reduction remained the same. Now this made this lack of investment a profitable move on our part. A financial structure. Talk a little bit about our ROE. Our objective was to have a 45% or above ROE during simulation year 8 results, and we actually wanted to do that by going from our current 8.7 to 30% by simulation year 5. As we can see, our company fell short of this objective by 22.29%, only reaching an ROE of 22.71 in year 2027 or in this year. And so although we were really ambitious in trying to reduce our ROE, we fell short of that, as you can see. As we kind of looked at our ROA, return on assets, our ROA continued to increase each year from round 0 to simulation round 8 or year 2027. So as you can see from 2019, it actually decreased and then it began to increase every year until this year. Our ROA was topped out at 14%, which was lower than our competitors, Andrew 23% and Digby 25%. So this is definitely an area, although we've continued to improve in our return on assets, this is an area that we want to keep a close eye on as our competitors have a higher ROA, 23 and 25%. So we'll look at how we can reduce this moving forward. Financial structure, as we look at our asset turnover, our objective as we began the company was to increase our asset turnover ratio by 2.2% by simulation year 8 or this year. We wanted to increase sales by investing into our promo budget and into our sales budget to raise, again, product awareness and accessibility in our marketing so that we can lead to higher sales without affecting our asset base. The results this year was that our company achieved an asset turnover of 0.9 last year. 0.9 this year, and then we fell short of our objective, excuse us for misspelling here, by 1.3. So we fell a little short than what we actually initially planned. Although, again, as compared to our rivals, we're not too far off, but this is definitely an area that we want to improve. We want to turn our assets a lot faster and be more efficient in generating money with our assets. Again, as I mentioned earlier, Chestnut had a marketing goal of obtaining 30% of the total market share for all its products, and we missed our goal by 4.5%. We obtained a total market share of 25.5 in this round of the simulation, or in this year, excuse me. Although this is still higher than the rest of our competitors. Our stock price, one of the things that is very important for you as an investor is we continue to show improvement in our stock price, and we're elated at the fact that we can announce that our ending stock price this year was $124.09, which is the highest, or the second highest stock price in our simulation, or against our industry rivals. Andrews actually stocked out a little higher than we did, but our stock price is still a very good investment for you guys. Here's our balance sheet. As you can see, some of our assets, our cash, inventory, and then you will also see our cash flow statement. This is again our closing cash position. What we have, we decreased in our closing cash position, but that's because we've also increased areas of finance as well. And then here you have our income statement. One of the things I want to draw your attention to here is our net profit. Again, our net profit was $43,239 last year, and we increased that to $60,617 this year. So our goal was to increase our contribution margin. Our objective in the beginning of the company was to do that by 48% by this year, by reducing our variable costs by 47%, and then reducing our material costs and our labor costs each by increasing into our TQM measures. And as you can see, earlier, we did invest in $1,000 into TQM measures to try to reduce our R&D cycle as well as our material costs, because we understood that by reducing our variable costs, we'd be able to increase our contribution margin. As you can see, we had a 49.07 contribution margin in round 7, and then a 47.2. It decreased a little bit this year. And that's mainly because our total variable costs actually increased. So our direct labor increased, our direct material increased, and that might be due to the fact that our R&D cycle time is a little higher, as well as the fact that we did not invest into our TQN measures. We're happy to announce in our analysis report that throughout the organization, we've been able to establish a solid share of the market. And we were able to score a cumulative score of 6,026 for the simulation recap. So this is kind of the recap of the last 8 years, and we've actually ranked pretty well in comparison to our competition. This concludes our portion of this board meeting. If you have any questions, please feel free to ask them right now. Again, you can take the illustrations and graphs with you. We saw high profitability this year. There's some areas that we need to address, including areas of ROA, as well as our net contribution margin, making sure that we increase that. But other than that, we are a very smart investment, and you guys are investing into the right company.